So I was at a trader show just recently, and I had to, and hopefully, I don't mind if this person is watching this show, because I think this is the sort of thing that's a good learn for most traders out there. And this is serious stuff. We're going to laugh during this, I'm sure, but this is really serious. The ultimate message that we're trying to get across. So I was comparing a prize giving to these where 3 people had won this top trader event where they could trade for something like 3 weeks prior to this trading show on a demo account. And the people with the best performance won a prize. And so I was there to compare that and to then ask them some questions and take some questions from the audience. And the person who won this trading competition, bearing in mind, yes, it's on demo accounts. We all know it's very different on demo accounts. But of course, I'm asking and probing questions on their trading style and whatnot. So it comes to light as I'm asking her just a little bit about her style and her approach. So she buys off support and sells, yeah, great, sells resistance and whatnot. And it came out that she said that she doesn't use stop losses. So I'm thinking, okay, all right, well, I'll probe on this. So I said, well, she said, but it's okay because I only take the trades that are gonna work.
Ouch. Yeah. Alarm bells.
Little flag there for you, ladies and gentlemen. There's no such thing as, oh yeah, I only take the trades that I know are going to work, because nobody knows. Anyone who tells you that they know that go to Jim Simons, who's a multi-billionaire quant trader. He's still only right 50% of the time on his quant funds, and so. Anyway, so the alarm bells were ringing, and so I said, "Oh, okay." And then the irony was, because I managed to get her to admit that, well, what happens if the trade comes lower? What do you do at that point? She said, "Well, it's okay. I hedge anyway." I went, "Oh, okay. So you are sort of using a stop loss because you hedge." So again, I'm questioning. So I said, "So if the price does come down, even though she's already said that she already knows that." Price is going to go, yeah. So if price does come down that bit further, so then you would just put a sell order in, you'd just sell down here. So then you're naturally sort of then hedged at that point. And I assume if the market comes back up, then you'll close your hedge for a small loss. And then, anyway, I don't know.
Yeah.
And she went, no, I buy more. And I'm thinking, that's not a hedge.
No, that's not a hedge.
No, that's martingaling. That's completely different. That's adding to your losers. That's not hedging. So, right, okay. So in the short term, anybody, and actually over a medium term as well, if you use martingale and you don't use stop losses and you add in to losers, which is what she was doing, you can make money and you can be highly successful. But one thing that you and I have been dealing with traders for the last 20 years, one thing that we know is that we've not met a single trader who's been trading for 20 years using martingale and is successful and hasn't blown up.
No.
So not without stop losses. You can use martingale or adding in to trades, providing you've still put in a stop loss. But if you don't use stop losses, ultimately there's always going to be that trade just keeps going, and then you just blow up. So that was, for me, the fascinating thing. You can have someone who won a trading competition, and I wouldn't advise anyone to trade that way.